Hey accountants, Mrs. Lamphere. With these next few sections, we are looking at several different special journals. And to start off with, in section 4, we talk specifically about the sales journal. But first, so the reason we have these special journals, it's kind of just an additional way to kind of ease the journalizing process, as well as then being able to post to the ledger accounts later on. And like these bullet points explain, it just provides easy and quick access to information in your journal. So there's just specifically 4 different types of journals that we'll be looking at. And in section 4, we talk mainly about the sales journal. And the sales journal only journalizes sales of merchandise that happen on accounts. So picture we are the business and we're making sales on accounts, so to other companies and businesses that have an account with us. So that would be our accounts receivable. So keep that in mind when we're going through these examples. So this is what the spread of a sales journal looks like. It is again used to record the sale of merchandise on account, and you'll kind of see some of these new additional columns here for recording sales credit, sales tax payable, and accounts receivable. So again, just like in T accounts, we're recording sales, so it's going to increase on the credit side for sales, increase on the credit side for tax payable, and increase on the debit side for accounts receivable. All right, so this is what an invoice would look at. So we're going to go through an example here of recording entries into a sales journal. So say we are Olympic Sportswear, and on January 5th, we sold merchandise on account to Kevin Sports for $400 and worth of merchandise and $24 worth of sales tax. And this is all recorded on invoice number 10. So this is what that invoice would look like. So we would send out this invoice to Kevin Sports, letting them know what they owe us. So when we want to record this transaction into our sales journal, this is what it's going to look like. On January 5th, we copy in our date. We put in our invoice number, which is invoice number 10. The account we're working with is Kevin Sports. They are getting their account credited by $400, as well as $24 for sales tax. And so this will, their account's being debited for the total amount, so $424. And then we credit our sales account and our sales tax payable account for those amounts. So that's pretty simple. That's how we would record this transaction to our sales journal. And let's look at another one. So this sale that we're making on account to Nathan Ashley High School, I just wanted to throw this example in there because I don't know if you've heard the term tax exempt, but a lot of nonprofit organizations, such as a high school, is considered to be tax exempt. So all that means is that we cannot charge them sales tax just because of the type of tax licensing that they fall under, which is tax exempt. So in this instance, Olympic Sportswear, our company, we sold merchandise to Nathan Ashley High School Athletics on their account, invoice number 11. And here we go. So we're copying this into our sales journal. On January 7th, on invoice 11, we sold to Nathan Ashley High School Athletics. So we're going, this is a credit in our sales account, $3,000, and we won't put anything into our tax payable because they're tax exempt, and we will debit their account for $3,000. Okay, so that's just 2 simple transactions that we are copying down into our sales journal. So once we've copied down all these transactions into our sales journal, we have to do these 4 steps of footing, proving, totaling, and ruling. So I'm going to actually take you to the text now to walk you through all of those steps. So say now that it's the end of the month and we're going to total our sales journal for the end of January. So here's all of our transactions that we made in January. We have our Kevin Sports that we walked through and our Nathan Ashley High School that we walked through. And then they had several other transactions throughout the month. And now it's time to total this page and post it to the appropriate ledger accounts. Like, that should kind of trigger some memories from Accounting 1 when we posted from the journal to our ledger accounts. So first it tells us to draw a line at the end of our columns, and if you remember, that kind of means that basically says we're going to add these columns up, and so that's what they do here. They draw a line, they total their columns, and we want to make sure, as always, that our debits equal our credits. So in this case, we have one column here dedicated to our debits and two columns dedicated to our credits. So they take those onto a separate page and add them up, our total debits and our total credits. Obviously, you can tell that those aren't quite the same amounts, but just to let you know, we need, well, maybe I'll pull it up here for you. So we have 31,461 in debits. If we take 29,850, that's 1,611, 31,461. So good. Our debits equal our credits. So now we can trust those numbers and enter in the rest of our line here, including our date. So what they do is they write in their date. It's the end of the month, January 31st. We add in totals, and these are our totals for each of those columns. So then once we've totaled our columns and we make sure that our debits have equaled our credits, we would draw that double rule line here at the bottom. If you remember from Accounting 1, we did the double rule line to indicate that our amounts are correct and we are balanced. So then, and again, this is just saying you would add in that double rule line to indicate the amounts have been verified. You just can't really see it on their example here. So once our amounts have been verified, we then need to post those amounts to the appropriate general ledgers. So we have this would be our sales, like our sales revenue ledger. Okay, and so then we just need to post the new balance that we have into our sales ledger. So they have a balance carried over to January 1st of $1,000. So we already had $1,000 recorded in our sales ledger. Now we're going to add in the ending balance for January. So it shows you the transaction here. It's taking you through on January 31st, sales journal, page 19. And step by step, they're crediting this account now for $29,850 because that was the total of that sales column. Let me just take you back. Oh, see right here, they'll show you that column total was $29,850. So we're copying that amount here into our ledger. And then we are adding what our previous balance was to get our new balance for sales revenue. Okay, and then once we've copied that over, they're demonstrating here that they referenced account ledger number 401 because that was our sales account number, just to verify that amount has been posted to the ledger. So then it goes through and takes you through posting our amount to the sales tax payable ledger. So same type of thing. We had a beginning balance of $20 already in this ledger, and we put in our date, the sales journal number 19, the credit amount, and then they add it to the original balance, giving us a new balance of $1,631. And then again, we mark down that we copied this amount, has been copied and posted into ledger account number 202, or sales tax payable. Okay, and then we also want to record our accounts receivable debit amount. So this is our accounts receivable general ledger. Here's our beginning balance in January, and now we are adding in our balance for the end of the month, giving us a new balance. So we want to figure out what our new balance is going to be. We have 2,250 plus 31,461. So our ending balance for the month of January would be $33,711, and that amount would go right here. And again, they show you that they reference that with account number 102. So then the next step would be once that they've copied all of those amounts into the ledger accounts, they're going to bring those forward starting on the new sales journal page for February. So you can see here that they just brought all of those ending balances forward, and those are the amounts that we're going to start with when we start with the month of January. So that's what it means to carry forward. We're carrying those balances forward to the next month. Okay, so also once we've copied those amounts to the appropriate general ledger accounts, don't forget about your accounts receivable subsidiary ledger. Okay, so for example, here's that sales journal again, and when we made those we copied down those two transactions. Now we need to copy them into their appropriate subsidiary ledgers. So if you remember, we have our accounts receivable subsidiary ledger, and we have account name for Kevin Sports. On January 5th, we copy down their transaction, and then we also have an account for NAHS Athletics, and we copy down their transaction as well. So don't forget about your subsidiary accounts and posting to those ledgers. And then again, this was just to show you also with the posting to the general ledger and getting that new balance. So we already looked at that example in your text. Okay, so then you might have noticed that the the assignments are a little mixed up. So this is where I want you to work on part 2 of this assignment 3, because that's where it talks about the sales journal and the subsidiary ledger. So you'll notice that these assignments, part 1 and part 2, are together, but you're going to start with part 2. So it walks you through a transaction, and just like we did in our examples in the PowerPoint, you're going to copy down this transaction into the sales journal and then also into the appropriate subsidiary ledger. Don't forget to copy down your accounts receivable account name. And if you have any questions, don't hesitate to ask.